150 points. The drag will come in from the IT names. So Infosys could lead the fall on the way down. Okay, the bell has rung. The first tick on the Nifty is down 120, 130 points. The Nifty opens at 19,650. Still down 140 points. Sensex has crashed 450 points. We're looking at a cut of 0.7% on the benchmark indices. The Nifty Bank has fallen by a similar amount, 300 points lower, 0.7% in percentage terms. Midcaps in the red, but the fall is not as much as what we've seen with the benchmark indices. To take you through the big losers, Infosys is the top Nifty loser, opens with a cut of about 3%, but this adds on to that 1.5% fall that we had in yesterday's trades. Over 2 days, Infosys has corrected close to about 5%. Other IT losers include Wipro, that's lost 1.5%. Wipro is the only large cap IT left to report numbers, reports on 18th, that's next week. Pull up in HCLTech. HCLTech has actually opened in the green. And here's the reason why. HCLTech is guiding for a very strong recovery in the second half of the year, 3 to 4% every quarter in Q3 and Q4. So they're very confident. So they have lowered their guidance, but the guidance cut is because of what has already happened, not because of what lies ahead. So HCLTech is bucking the trend this morning. TCS too, because relatively, TCS performance was not as bad. So TCS is opened flat after the correction yesterday. Axis Bank has seen a cut of 1.5%. There was a downgrade by UBS. So Axis Bank and State Bank of India, both of them down 1.5% to 2%. On the gaining side, as we said, HCLTech is the big surprise mover, 1.7% up. TCS in the green, SBI Life, Hero MotoCorp are some of the other stocks which are resilient. But on the whole, it's trimming its losses, now 100 points down. So open with a cut of 140, but now down 100 points.
Well, if you bought the dip, you'll be happy, right? You're already 40 points in the money as we speak. And just one more data point. We started at 19,653. We need to end somewhere around there or even higher to have a green week. So that's the important point. We moved to around 19,700 odd. And just pull up the IT index. That's recovered a goodish bit. Stocks like Infosys, case in point, now they're down only around 2.5%. It was down close to 4.5% odd. So there's a big recovery that we're seeing in tech on the whole. LTI Mindtree has moved into the green. That's opened up in the red. TCS as well has moved into the green. So pretty good going on that front. The stock that I'm looking at is HDFC Bank. It seems to be finding its form in the second half of the session. Normally has numbers over this weekend. That's going to be the mover today. If that can move, that's what's going to help the bulls recover even more from here. We're up close to around 60 points from the low point of the day. So keep an eye on that front. A couple of stocks in the broader markets though. Ircon is up close to 5%. Good going out there. MMTC refuses to budge. The stock is up another 3% after going up 19% yesterday. Vodafone Idea is up close to around 1%. And Z Media, the last few sessions, it's been moving quite well. So that stock as well, on a low base, that's up more than 10%. Volume's rather high on that counter. Manglam, but 60 points from the day's low already.
60 points from the day's low already, Nigel. The low on the on Infosys today is 1,400, and that's exactly where a lot of puts were written. So from those levels, we've seen a recovery of a good 30, 31 odd rupees on that stock, and that explains the recovery on the Nifty from the lows. A couple of broader market stocks that really stand out. One of them is HDFC AMC. Reported their numbers in the afternoon yesterday. The street has passed through them, the earnings presentation, etc. And that seems to be the top gainer in the F&O pack this morning itself. Among the losers, we do have United Breweries, which is down about 1%, was a good mover in yesterday's trading session. But Nimesh did indicate that, there could be some negatives as reported by Citi for the company. Angel One from the broader markets doing well as well. Decent numbers coming in from them. And Kesoram, you've been talking about how, the EBIT loss in their rayon and chemicals business has expanded, as a result of which that stock is lower too. One stock really stands out in terms of moves from the broad markets is AGI Greenpack. Now, this stock has been a big mover. This year itself, it's rallied about 200%. So that's a 3x gain that we've seen from the start of this year. And this stock doesn't seem to be stopping, up almost 6% odd as we speak. The erstwhile HSIL now surging 200%. So it's hit the double century in terms of gains this year. RITES gaining along with Ircon. So the entire railway pack, we have RailTel, RITES, Ircon, all of them buzzing around. So the broader market actually looks a lot better than the frontline end of things. The Midcap index opened with a cut of 0.4%, and swiftly, if you pull up the intraday chart of the Midcap index, you'll see it's just about breaking into the green. So the underlying texture of the market continues to remain extremely strong, now down by just about 25 points for the Midcap index. The Nifty too firmly above that 19,700 mark.
Okay, let's get in some expert opinion on the way forward. How would you navigate all these cues? Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC, is with us on the show. Mahesh, morning, and thanks so much for joining in. Rima here. Incremental money, where would you put it right now? Because markets refuse to fall significantly. We're just 2% off from our 52-week high levels, all-time high levels, actually. So if you have fresh money, which you keep getting, where are you deploying it?
Yeah, good morning. So, yeah, markets have been fairly resilient, I think, despite, we've seen that some concerns coming in again from the global front in terms of interest rates, remaining higher for a longer period of time. And it's not in Indian markets itself. I think the global markets are also holding on fairly well. So at this point in time, again, I think the key risk what we see, right, going forward is likely to come in from the global front, because that's where the sharp increase in interest rates are. And that's likely to really lead to some kind of impact on the economy. We could see a slowdown coming in probably a couple of quarters down the line. And some of our globally linked sectors, which are linked to global growth, is where we'll be slightly cautious and try to stay away from that. I mean, unless the valuations really support that. I think India growth is still fairly strong and resilient, though it's nothing to really rave about. It's slowly picking up, but it looks to be much more steady. And a lot of the sectors, like, for example, if you look at real estate sector is doing very strong. If you look at across all the micro markets, the demand is fairly good. Inventory levels are low. So that sector looks good, and that will mean all the building materials should do well. Overall credit growth in the economy is also fairly strong. In fact, it's better than what you were expecting at the beginning of the year. And that should help the banking and financial services sector. Also, with rates likely to remain higher for a longer period of time, I think the NIM compression, which one was expecting in the banking sector, I think that will happen in this quarter, but I think you will see margins remaining fairly decent. So that sector also looks good to us. The auto sector has seen a good recovery in the last 1 year. But still, if you look at the volume, especially in two-wheelers and other sectors, they are still well below, slightly below or near the pre-COVID levels. So there is enough runway of growth going forward over there. So I think a lot of domestic-facing sectors are showing good amount of resilience, except some amount of slowdown in the discretionary side. But again, that we think should also come back. We have to watch this festive season. Also, the rural economy, which has been weak, and the sector, we are seeing some amount of now slow green shoots over there. They're still early. But being an election year, I think you will see some amount of money being thrown at the lower end of the population, and that should drive some amount of consumption also going forward. So I would say that sector specific, I think some of the domestics like banking and financials, for example, where we are still overweight, auto sector, real estate, consumer discretionary, are cement, are the sector, even telecom for that matter, right? So telecom has, in this kind of an environment, you require sectors where there is steady visibility, there are no negative earning surprises. And the telecom sector should see a good amount. I think we have seen the peak of the capex cycle now this year on the back of 5G. And next year, you should see large capital free cash flows from some of the telecom names. I think we should drive the overall equity growth over there.
All right. Hi, Mahesh. Good morning. Mahesh, what's your view on the IT names? You know, a couple of months ago, I think we were discussing, you had mentioned that IT could be a contra buy, when everyone's getting a little bit gloomy on it. These numbers are not too great with regard to the way ahead. Would you be a buyer for a medium to long term on the IT stocks?
Yeah, so IT, as I said, it's a contra buy because the near-term outlook there is weak, and we all know that, right? There's some concerns, discretionary spends are weak, and near-term, it's still not clear where the whole US economy, when it bottoms out, again, when it does that. But so given that, I would say that in near-term, after this couple of 2-3 large results, what we have seen, it seems that it will still take some time to recover from here. And to that extent, I think you will see the performance in the IT stocks would get pushed back. They still continue to maintain the view that over a medium term, long term, I think the whole move towards digital spending and tech spending is not going to slow down significantly, and we will still see growth rates which are slightly higher than what the pre-COVID run rate was, which was somewhere in the mid-single digits. So from that perspective, I think the medium long-term outlook for IT still looks good. And the Indian companies have still done pretty well. Some of the companies have, while the top line growth has disappointed, on the margin front, I think they have shown better kind of a performance. There are some margin levers which are there in terms of improving productivity and increasing utilization, I think, which should support the earnings growth, right? While the top line growth will be slightly weaker, but the bottom line growth could be slightly better. So I would still maintain that it still remains a contra, but I think don't expect any near-term outperformance in the sector considering the global listing, but can be a good sector for, I would say it can also be a slight defensive in that sense, because a lot of negatives are already priced in or known in this sector. And there are other sectors, okay, where they still don't know, okay, what negatives could pop up, especially linked to global growth. So, yeah, so while remaining cautious on the IT sector, I think any correction, I think one should look to add over there.
All right. Seems like you've been a bit of a messiah for the mid-caps. As soon as you joined, now the mid-cap index has moved into the green, closing in on that 40,600 mark. A lot of the F&O stocks doing well. We have Vodafone Idea, which continues its march forward. So this week itself, the stock has rallied about 12%. So that's something we'll watch out for. Though, on an absolute basis, just a 12 rupees stock. So just watch for that one. Nippon Life yesterday was up around 12% towards the close, and this morning opened lower. Quickly that dip was bought into. That stocks moved to the high point of trade. But if you're looking at just the F&O stocks, then perhaps you're missing out on the bigger moves that we're seeing in the cash markets as well. ITI, that's up 7%. Zaggle Prepaid, a recent listing. We had the management here yesterday saying that incrementally they will see more revenue coming in from their new product, which is Zoyer. And at the same time, reduction in their finance costs would aid their profitability going ahead as well. Yesterday, it was a bit of a softish performance on the stock, and now it's up around 7%. Mahesh, earlier you had said that, the mid-caps and small caps are seeing a fair amount of flows and the outperformance is likely to continue. It has played out so far. You liked a couple of the new listings as well. Your thoughts on how long this outperformance can continue and at what point it becomes expensive?
So the mid caps and small caps in the last 9 months have seen a good rally, good outperformance vis-a-vis even the large caps and in absolute terms. So technically, if you look at in terms of outperformance and historically, if you compare that, then I think it reaches a point where I think one can see some kind of consolidation there, or even relative underperformance if the market's correct, right? Because the risk to mid cap or small cap is if there is a global risk off, then you will see a larger correction over there. But I think I still believe that mid cap and small cap stocks, from a slightly long-term perspective, I think can continue to do well. I mean, valuations are higher there and performance, so you can see a short-term correction or a pullback over there. But we don't see any major concerns over there. Obviously, it has to be more stock specific, specifically in the small cap segment, because where the market is very, very diverse, right, over there. And there are a lot of pockets in small cap space where there's a lot of exuberance which has been there. So one needs to be more careful in that sense. But overall earnings growth for the companies is fairly good. And that's more important, right? While valuations are expensive, the earnings growth visibility is there and continue to grow. And a lot of, as I said, India's story looks good. Small caps specifically are more linked to domestic growth. So that should, I think, over a period of time, really take care for the slightly higher valuations which are there. So we are not aggressively pushing mid caps and small cap at this point in time. We're seeing that, okay, continue with your SIPs. Okay, don't do any lump sum over there. Large caps at the moment look slightly better. The risk reward is slightly better in the large cap stocks, and that's where the slight tilt should be. But for long-term investors who are looking at long-term wealth creation, I think small and mid cap they can continue to hold, and I don't see any major concern, because the direction I think still looks to be on the higher side, barring some minor pullbacks, okay, which can happen.
Mahesh, out of time. Thank you very much for joining in. Enjoy the rest of your day and the weekend and the match. Are you going for it?
Not really. Watch it.
Okay.
Yeah. Thank you. Bye. Good day.
Thank you. Thank you. Have a good day. By the way, Infosys is seeing buying from the day's low. It opened with a cut of about 4%, now down 2.5%, and it's holding above its 200-day moving average of 1410. But HCLTech is the big mover, 3.5% higher as Q2 was a mixed bag. The company lowered its guidance for the full year, but the company is guiding for a very strong H2, Q3 and Q4. I had a chat with the management. Listen in.
We would have expected a little bit more of revenue, but if you look at the Q2 revenue breakdown, there is services, and then there are some assets which are also embedded into that services P&L, and then software. Our asset revenue reduced about 25 million. It's a very tactical thing that kind of dropped by 25 million based on some projects which where the execution got over. So other than that, if you take the services within services, it's a pretty strong growth. It's probably close to 2%.
Okay. So the only reason for the Q2 miss compared to expectation was this $25 million reduction in the asset revenue, right?
Yeah.
Okay. Yeah. Peers like Infosys are guiding for negative growth in the second half of the year. Your guidance implies a very strong 3 to 4% pickup in both Q3 and in Q4. What makes you confident that you will be able to achieve it?
Rima, first of all, the nature of our businesses are different. And if you look at our outlook for Q3, it's informed by three factors. One is the large deal which will go live by 1st of November, which is going to give us some significant revenue in Q3. The second aspect is for the software business, it is seasonally one of the top quarter, which means O&D will see a spike in the software business. And the deals that we have signed in the last 2 quarters, some of them, the transitions are over. They will go into steady state starting maybe end of October onwards. And also there is some flow-through impact of the revenues that we had in September, which will have a full quarter impact. So all of this adds up to a good outlook for Q3. And a similar extrapolation to Q4 is possible because even the large deal will continue to have an incremental growth in Q4 on top of Q3.
Okay. Just on that point about the Verizon deal, which will start contributing from 1st of November, how much will it contribute in November, December, and Q4?
Rima, we do not call out client-wise numbers, but of course, a lot of optimism is built because of we are going live, things are on track. I think that's what is giving us this optimism.
Prateek, can you tell us what led to the margin expansion, sequentially 140 basis points?
Yeah, sure. So there are 3 or 4 factors. I think if you see our cost breakup that we give in great detail, one of the pages of the investor release, there is a sharp reduction in the expense on third-party contractors, which is 70 basis points drop. Apart from that, other discretionary expenses like travel, like legal expenses, other discretionary expenses also saw a sharp drop, 50-odd basis points. And then, of course, the headcount reduction also led to some savings there. So in total, we have driven a lot of cost savings this quarter, and that has delivered. It's actually 150 basis points improvement on a quarter-to-quarter basis. It is a 50 basis points improvement on a year-on-year basis as well. So that is, what drove that.
You are giving a wage hike from 1st of October. What will be the margin impact in Q3 and in Q4?
So Q3 should be about 60 to 65 basis points. And Q4 should be another 25 to 30 basis points on top of that.
Okay, 60 to 65 basis points margin impact in Q3 and about 20 to 25 basis points in Q4. Prateek, this cut in discretionary expenditure like travel, legal costs. Are you embarking on some sort of a cost optimization, cost-cutting plan at HCLTech? Because historically, your margins used to be, 19, 21%. That used to be your guidance 2 years back, and now you've brought it down. So do you think the company, are you on some cost optimization plan to get back to those margins above 20%?
Rima, that's an excellent question and a very intuitive one. You are absolutely right. We have voiced our aspirational margin to get back to the 19 to 20% band. And that is what we are very laser focused on. This year is 18 to 19%. We started the first quarter week, as you know, 17%. So that was like little below. And we've ramped that up in the current quarter. And we'll definitely be in the 18 to 19% for this year. Obviously, it's a slow growth year compared to our, last quarter. Last year, same quarter, we had a services growth of 19%. Those days are gone. It's a different macro that we are going through right now. But as soon as the margins will also follow the revenue growth as and when we get that growth back.
CVK, just purely executing the large deals that you've clocked in over the last few quarters, including the current one at $4 billion, do you think double digit is possible in FY25?
We have a very, very good large deal execution track record, right? Right from the days of Volvo to many, many large opportunities we've executed, which is across multiple geographies, multiple technologies, people, all of that we've executed well. And that's what we're going to do for the current strategic partnership that we have in hand. I think it will continue to give us good momentum going into FY25. But I think it's a little too early to kind of view what FY25 will look like. I think the planning cycles are getting a little shorter. Whatever plans you make may not hold good 3 months down the line. So there are too many variables at this point for us to get any sense of 25. But all that I can assure you is we will have a strong exit because Q3 is going to be a strong quarter. Q4 will be another strong quarter on top of Q3. So we will exit strong. I think I have visibility only till then. Then we will have to see as it comes.
So after this near $4 billion of deal wins in Q2, what's the pipeline and the funnel? I remember in our last interview, you said the pipeline and funnel is at all-time high levels.
Yes. So last quarter, it was at an all-time high with the $4 billion of closure. Obviously, pipeline has come down a little bit, but there is also a lot of new pipeline which has got added. So at this point, I am about 10%, to be precise, 9% below my peak pipeline. That's where we are.
Got it.
And a lot of that will convert this quarter and next quarter, which should give us some more momentum into FY25.
So deal wins in Q3 and Q4 based on your pipeline, which is still very strong. Will it be closer to that $4 billion or will it get back to that average of $2.5 billion that you've been seeing for the last few quarters?
Rima, to be honest, the $4 billion is an outlier. We've been clocking 2 to 2.5. So my aspiration will be to get closer to 2.5. Even though our baseline is generally 2, on a good quarter, we could get to 2.5. That's the kind of band that we are working on. 2 to 2.5 billion. And Rima, once again, I want to reiterate the bookings that we disclose are all net new bookings. These are all new deals, firm deals that are signed. This does not include rate card deals, framework deals. This does not include renewals. So it's really incremental commitment from the customers. That's what is counted in the new bookings that we disclose.
Very quickly, CVK, the performance was weak in manufacturing and technology. Do you see it reversing anytime soon?
See, manufacturing was a technicality. Initially, I talked about assets. 25 million was less, and that had a big contribution coming from manufacturing vertical. So, from a pure services, I think it will continue to do well. Technology, I think, we had a very small decline this quarter. I would say it will take a couple of quarters for the tech vertical to start showing good growth.
All right, that is a reasonably confident management of HCLTech, eyeing the second half to be a lot better. And FY25, of course, will be supported by a bunch of deal wins that the company has done. The stock higher by almost 3%. Take a short break, come back. On the other side, we'll be joined by P. Radhakrishnan, who's the whole-time director and CEO at Kesoram Industries. Focus on what to expect from the second quarter numbers of the banking sector in our special segment, Quarter Se Quarter Tak. And to take that discussion forward, we'll be joined by Ashutosh Mishra, who's the head research institutional equities at Ashika Stockbroking.
Welcome back. We have a 70-point recovery from the day's low. Now, you'll be a little bit confused what you should do from here if you bought the dip. So we'll need to move higher, actually. And the Nifty Bank will have to perform because that leg continues to drag. The IT index, though, has come off considerably from the low point of the day. But we've been talking about a lot of IT numbers. There's another smaller company, Kesoram Industries, that reported an operationally weak set of numbers due to pricing pressure. The rayon business as well continues to struggle. The company, though, is likely to deliver far better performance in the next quarter. Mr. Radhakrishnan, the whole-time director and the chief executive officer, joins us on the show. Hi, Mr. Radhakrishnan. Well, these numbers look disappointing. No two ways about it. I think you'll be lucky to see just a 2% cut on the stock. But clearly, the street is looking at the way ahead. So give us a couple of details. A few days ago, you joined us. You told us you're likely to push through a price increase, both in South India as well as in West India. Has that price increase been absorbed?
It's been crystallized at rupees 30 per bag on an average as we speak.
30 rupees per bag. Okay, all right. That's been absorbed both in West as well as in South as well?
Yes. Yes.
Okay, so that'll be good then for your profitability. Now, at the end of the first quarter, first and second quarter, your EBITDA per ton is still, hovering 550 or a little lower than that, maybe closer to around 500 as well. On an average, it's lower than 550. But you have been telling us that you're looking to do 650 rupees per ton. And for the year, you'll do 8 million tons. Hold on to that guidance?
I do hold on to the guidance of 8 million ton as we speak. And we should be doing about maybe 650 should come anywhere between 625 to 650. Still, 650 is not out of reach. Plus or minus 25 rupees.
And this 625 to 650, you're referring to an average for the year, right? So that means the second half of the year will have to be closer to around 700 rupees to get to that number.
Yes, very much.
How sure are you, Mr. Radhakrishnan? Because, time and again, the street thinks that you all could downgrade it again. Are you quite confident now? Input costs have cooled off, but they're yet to reflect for you. And your price increases will help. So are you sure, or do you believe that still you'll be a little bit skeptical about this number of around 625 to 650 that you're talking about?
I think we should be there. The way I look at it is, there has been a decline in input cost in Q2, but it is not getting reflected in our number adequately as we have consumed from stock, from the opening stock, so far as the fuel is concerned. Therefore, this will get reflected in Q3 numbers as we move forward. Therefore, given this background, I'm confident we should be achieving close to what we have guided.
All right. Mr. Radhakrishnan, let's talk about the other smaller part of your business, which has caused a bit of a drag on your operational performance. That is the rayon business. Time and again, we've asked you about the break-even prospects of that business. When does that happen? And what does a sustainable operational performance look like for that?
Q4 of this financial year, we should be breaking even on Rayon. And sustainable profit for that business will be about 45 to 50 crores of cash generation for that Rayon. We are in a fairly, as I outlined, with a global major, we are in a fairly advanced stage to ink a definitive agreement. Once that is there, we should be in a position to scale up our transparent paper and Rayon business.
So you want to you're inking a definitive agreement to demerge the business, and then you want to scale it up.
See, first is to bring in the partner, do the definitive agreement, and then we will look at demerger. The first is to bring in the necessary technology to scale up.
So why not sell it?
And the infusion of capital. So once you bring in the partner and scale up, you get more value, whatever you want to decide at that point in time. Now the focus should be to create value in the business.
Okay. You know, as Rima said, why not sell it? But you seem to be keen on running it. So we'll let you run it. You know, instead of demerging it, getting a partner, ramping it up, a better option. And the stock market will be very happy if you do it. But you want to run that business. So we take your point and you'll break even by Q4. So we'll hold you on that number. The biggest problem for you is debt. And time and again, you've said that, you know, you're close to refinancing. Maybe there'll be some debt repayment. Now, give us two points. One, by when will you refinance? Is Q3 the time, sometime during the quarter, that you'll refinance the debt? Point number one. And also, I think you've repaid some part debt, or you had some small 30-40 crores of repayment that were due. Did you do that? Why exactly is this finance cost higher?
So what we have done is we have repaid whatever is coming up for November. So whenever there is a short spikes of liquidity, at the first instance, we try to repay the upcoming maturities. That's the way we function. Now, Q3, we should be through with either Q3, we should be through with the refinancing. Or if it spills over, maximum by January, February, we should be through.
So what happens to your finance cost? Because you had then told us that, you know, you will look to reduce your finance cost to say mid-teens to low teens. What does it currently stand at? And post-refinance, what do you anticipate it to be?
Currently, it is at 19%. So the way it is getting delayed is we are not trying to target mid-teens now. Or we are trying to do below teens. Between 10 and 11% is what we should leapfrog. That will clearly give 200 crores of cash available for us. Right.
The street will appreciate your effort, Mr. Radhakrishnan. The problem is it's not happening. You know, Q1, Q2, Q3, it seems like you're kicking the can down the road. So are you confident now? You know, there's been various stocks. I'll tell you what the stock market wants. They want to see some kind of equity raise maybe to repay some debt. It'll give further confidence to the person who's going to be refinancing this debt as well. Are any of those two on, and could you be sure about it?
Good things take time, Nigel. So this will happen, right?
Yeah, but every time...
Yeah.
No, we understand that good things do take time, but you know, every time there is a good thing promised, then you look for a better thing and kick the can further down the road. Earlier it was mid-teens, then it was low teens, and now you're looking at high single digit, but you'd rather pay low teens now than pay high teens for the next 3 quarters, right? In anticipation of coming at high single digits. Just wanted to understand your thought process here, sir.
Yeah, we have come a long way. We have been perseverant in our effort. If you look at Kesoram balance sheet, 5,000 crore debt to 1,800 crore. That's where we have come. So we are absolutely confident it has paid off whatever we have done to bringing down the debt level to substantially lower levels. The only problem is the high rate of financing. We will definitely do that by this financial year. And I have clearly stated the quickest way to bring down is to bring in equity. What it takes us to bring in equity, we will bring into the balance sheet. That will be my endeavor as a whole-time director in this
So
organization.
refinancing in the next 2 quarters and bringing in some equity as well is on the cards. Could it be a rights? Could it be a preference issue? What will it be?
Whatever it takes, whatever form it takes to bring in equity into this balance sheet.
But you're looking to raise equity. You're looking to raise some equity.
Absolutely. We should. Only thing I have to take it past the board once the contours are finalized. So we will definitely add up once it is finalized and approved by the board.
Okay. Thanks a lot for joining in, Mr. Radhakrishnan. We're going to hold you to all these numbers, and hopefully next time around the goalpost doesn't shift. So you're looking at volumes of 8 million tons. The EBITDA per ton, well, that will have to move to close to around 700 rupees per ton for the second half, refinancing the debt, maybe raising some equity as well, and breaking even by the fourth quarter in the rayon business. Thanks so much for joining in. Plenty of promise. Now, delivery is the only thing the street will look forward to.
Okay, let's move on then to the big sector, the banking sector. This is our special segment, Quarter Se Quarter Tak. Abhishek is here to lay down the expectations from the banking sector this quarter. Abhishek.
Well, banking sector, thanks to the merger of HDFC Limited with HDFC Bank, saw robust loan growth of almost 20% year-on-year and more than 8% quarter-on-quarter at the end of Q2 FY24. However, the sector may continue to see pressure on the net interest margins, or as we call it, NIMs. This is on account of some key factors like cost of funds, which is rising, the end of loan repricing cycle, and incremental cash reserve requirement by RBI, that is ICRR. We may see managements lowering their FY24 or the near-term guidance on net interest margin than the numbers they gave after Q1 FY24. Deposit growth has been lagging the loan growth, hence one needs to watch out for the deposit growth for many banks. Incrementally, the system is at a CD ratio, or credit deposit ratio, of more than 78%. At a time when liability rates or deposit rates are at peak, the incremental cost of funds would be a costly affair for the banking sector. This can have a negative impact on the net interest margin of the banks. Now, private banks' pro forma business update has been pretty strong. They continue to take away the market share from the PSU banks. Expect slippages or bad loans in a quarter to be on the lower side and better recoveries to aid in improvement in asset quality or the gross NPA and net NPA. Operating profit growth could be weak due to weakness in the net interest income or the NIMs, but lower provisions can aid in strong earnings momentum and may see return ratios remain healthy for all the banks. Now, private banks may continue to invest in their franchisee, which could keep the OPEX or the operating expenses of these banks elevated. For PSU banks, expect strong improvement in their profitability and return ratios over the last few years or last few quarters to continue. We have some of the estimates from Kotak Securities. So for SBI, they are expecting NII growth of 24.4% YOY and a decline of 3.9% quarter-on-quarter. On the net profit for SBI, they are expecting it to go up by 175% YOY and a decline of 0.1% quarter-on-quarter. For ICICI Bank, Kotak Securities estimates NII growth of 20.2% YOY and a decline of 2.5% quarter-on-quarter. For net profit, they are expecting ICICI Bank's net profit to grow more than 25% YOY and a decline of 2% quarter-on-quarter. For Axis Bank, the NII growth is estimated at 15.8% YOY and about 0.4% quarter-on-quarter. For net profits, they are expecting it to go up by 9.7% YOY and about 0.8% on a sequential basis. Back to you.
All right, Abhishek, thanks a lot for laying down what the expectations for the banking sector in the second quarter would be. Importantly, the Nifty Bank currently at the low point of trade. We're seeing Axis Bank down almost 2% odd. There was a note coming in from UBS on that counter. SBI is the other one, which is down about 1.5% as well. As a result of which, the Nifty too has slipped mildly into the red once again, rather mildly around that 19,700 mark off highs as well. The Adani Group stocks have moved lower as well. Adani Ent, Adani Power, Adani Ports, all of them at the low point. But let's talk about the banking space itself. Ashutosh Mishra, who's the head of research institutional equities at Ashika Stockbroking, joining us now. Ashutosh, we've had a lot of second quarter updates coming in from banks already, over and above what Abhishek has spoken about in terms of expectations too. What are your three key factors that you'll be looking out for in private and public sector banks this time around?
So the most important factor will be the deposit growth. Like I say, highlighted this time, what we are seeing that the bank is lagging on the deposit growth substantially compared to the credit growth. And especially if you look at the CASA deposit growth is quite low. So it will have a negative bearing on the NIMS projection of the banks going forward from here. So we will be closely looking at how the banks is managing their low cost deposit and NIMS going forward from here. Second important point I will be looking at, the loan growth is quite high and this most probably will moderate from here. There is a merger impact also which is getting reflected. So which segment bank is going to focus, where they are going to bring a next leg of growth, and especially when we are talking at this point of time that there is some early warning sign is coming into some unsecured retail portfolio. So how they are going to manage this dynamics of margins versus loan growth.
Ashutosh, in fact, talking about those early signs, warning signs that we are getting on the unsecured retail portion, just reading out the UBS note, which has come out on banks, where they've turned neutral on the sector and downgraded State Bank of India and Axis Bank. They're saying they take a deep dive into the unsecured retail loans, which has gone up by 27% CAGR from FY18 to FY23. They now account for 8 to 12% of the loan books of the banks that they track. They believe the risk of defaults is rising as the share of lending to the already overdue borrowers, that's 1+ day past the due date, has risen from has gone up from 12% to 23% as of last year.
Yes,
how much of a concern is this, according to you? And can this really derail the entire banking story?
So we need to focus on 2-3 economic data points to see whether this will become a trend going forward from here, or it will just remain a warning sign where the banks will improve some of their underwriting practices to take care of this issue. So one most important factor will be how the spending both from the private and public sector continue in the government side, continue in the economic front. If the economic growth remain very robust in the next 1.5 years, at least from here, we are not going to see this becoming a major problem for the banks. Only thing it will be important that how the bank really change their underwriting standard on these loans and adjust for the increased risk which is getting built up at this point of time in the system. Yeah, this is time to relook into these underwriting practices which they currently are following for these loans, and slightly tightening up the whole process. The bank which will be able to do it, they will be a winner. Otherwise, yes, some banks may face the asset quality issues from some of these borrowers.
What are your thoughts on the sector positioning itself going forward? I mean, how would you, deploy, or what are your ratings on private banks, public sector banks, and NBFCs in light of the environment that we're in right now?
So my preference will be on the banks which have a relatively higher proportion of low-cost deposit, especially CASA deposit is there. That is becoming a very important factor going forward from here. And especially the large, both private and public sector banks are well placed in this category. So in my view, smaller banks will face a much higher proportion of margin compression going in the coming quarters compared to the larger bank, where they are really having a high CASA ratio, and not at the only high CASA ratio, but they are offering much lower interest rate compared to many of the other banks which have high CASA, but at the same time, they are offering higher interest rate. So the deposit cost will be very important. Mix of deposit and is very important for me. And from that category, I remain very positive on the large banks, both in the private and public sector space out there. So yes, there is some underperformance is there at this point of time, but the way things sector is planning out, they will be much better going ahead. Second space which we really like is the microfinance. Things are a lot changing in that space, and there we are clearly finding there can be some good banks and NBFCs which can continue to deliver strong growth as well as profitability from that space.
Do you want to tell us your top 3 picks, taking into account large banks, MFIs, NBFCs, everything, including the top 3 picks for you?
So if you look top three picks, I clearly say the contra bet on HDFC Bank at this point of time. I clearly see this is a good time to look at this. The way things are panning out, they are very well placed to advantage. Second will be Bajaj Finance. I clearly see they are very well placed to, again with the recent fundraising and other, they are very well placed in. Third is the Bandhan Bank. It's a very good play on an MFI and the whole the things is panning out in the banking space. So these three will be the best pick from the banking space.
Okay, Ashutosh, thank you very much for joining in. Look forward to hearing your comments as the numbers start trickling in. It begins with HDFC Bank on Monday, the first time as a merged entity, the company will be reporting numbers. Get into a break. On the other side, we'll put the spotlight on commodities. Manisha Gupta joins in as always.
Welcome back. Well, the markets are trading with a bit of a cut, but let's focus on a couple of names, MMTC as well as ITI. Both of them have spiked up. They moved to the high point of the day. So just pull up the intraday charts of both those two. And volumes as well are picking up. But just need to caution our viewers on ITI, the total free float in the market is very, very limited. You have the promoter entity, which is the government of India, that has more than 90%. And then you have a special fund as well that's also a government entity out there. So basically less than 2%, 2.5% is in the market. And for MMTC, there's around 7% in the open market. So low float is a game that's playing out again out here. So just want to alert our viewers that take note of that before you take any calls on some of these stocks. The markets, though, they bounced up a goodish bit, but now they're giving back some bit of that. Mitesh Thakur joins us to help us out with what you do from here. Mitesh, if you bought the dip in the morning, you'll be happy because you got a bounce. The problem is we've corrected close to 30 points again from the high point of the day. So for those that are playing the index, should they part book some profits and also give us your trading picks?
Morning, Nigel. My sense is they should book out the entire position. I think, today's gap down has definitely damaged the hourly and the 2-hourly charts. And while you were lucky to get some bounce back from a very weak opening, a gap down opening, I think, this market will see now in the immediate term supply at higher levels. So chances of us heading lower is slightly more. And therefore, I think taking profits would be a good idea. On the stock side, though, I have two buy calls. In fact, it's the oil and refinery sector, which is doing very well. I think part, credit to the prices of crude. So I have a buy on IOC which I would recommend buying with a stop below 89.5 for a target of around 94. And ONGC on the other spectrum is a buy as well. Disclaimer, we have some options positions on ONGC, so there is vested interest. But I would recommend buying here with a stop at about 183 for a target of around 192.
Thank you very much for that. Let's turn our attention then to commodities. Manisha is here with us. Manisha.
Rima, thank you so much for that. I'm looking at the crude oil prices because while we did see some profit taking yesterday in the New York session, we have seen the crude prices rebound back yet again. This is after the US has, for the first time now, sanctioned oil tanker companies which are carrying Russian crude oil, which is above the G7 price cap. Remember, G7 has put a price cap on Russian crude oil prices at $60 a barrel. And we all know that the prices have been trading above that. So while that supply from Russia should have gone down, but we do understand that some of the tankers are still carrying Russian crude oil because that is available at discounted rates to the Asian consumers. So this is the first of its sanctions now coming in for the tanker companies. Apart from that, the support also comes in as OPEC says that the global oil stocks will fall or get into a deficit by 3 million barrels per day in the fourth quarter. That is the current quarter. That is because we are looking at lower supplies coming in from OPEC and allies. But when you look at the US numbers, well, those are clearly on the bearish side. You have the production, which is now at a record 13.2 million barrels per day. Earlier record has been at 13.1, which was in March 2022. Also, when you look at 2020 rather, also when you look at the inventories in US, well, those have been surging higher as well. We've seen previous weeks see an inventory surge of 10 million barrels. So now we stand at a 424 million barrels into the US markets there. So that is what is keeping the prices in check here. Having said that, Russia says that the current oil prices have factored in the West Asia conflict. So we are pretty much in the prices there. Also, when you look at the support coming in for prices, that comes in from gasoline inventories in US, which have continued to decline, telling you that the demand there is on the positive side. So we have seen 1.3 million barrels of an inventory decline for gasoline. Same has been the case for distillates as well. Also watch out for the demand forecast for this year and the next as well. So while we talk about this year, IEA and OPEC are on same page, barely a 0.1 million barrel per day of a difference. It is the next year that there is a big gap between IEA and OPEC expectations of global demand growth. So while OPEC is quite bullish at 2.25, IEA believes that it is going to be less than a million barrel per day of a demand growth. So this is a number that we will see perhaps correcting in the days to come. Having said that, the expectation is that you could be looking at some support continuing for the crude prices. For this week now, we are up by nearly 2% for the crude.
Thank you very much for that. Some more stocks which, come up on our radar. Zaggle reported the Q1 numbers yesterday. Didn't look too good, but today the stock has surged close to about 12.5%. BGR Energy won an order a little more than 100 crore rupees. So that stock has surged close to about 7.5%. And Angel won very strong Q2 numbers and stock has surged 5%. RITES and IRCON are the other two stocks on our radar. Vivek joins in for more. Vivek.
Well, good morning. That's right. So both of the railway PSU stocks are in focus, both RITES as well as IRCON. So what's actually happened is that, both of these companies, which are under the Ministry of Railways, the government has gone ahead and upgraded their status to a Navratna status. So what this basically means is that, all of the CPSE, the public sector enterprises that are, financially viable and have got a certain amount of financial performance that they have displayed over a period of time, get this particular upgradation of their status, which means they have increased financial independence to go ahead and actively compete for orders and also go ahead and actively make a larger financial decision making up to 1,000 crore. So now what happens is that these companies can invest up to 1,000 crores independently without the central government approval that they required earlier. What does IRCON do? IRCON is number one, the infra construction space across roads, highways, bridges. All of them come under the Ministry of Railways, remember. And RITES offers transportation, infrastructure, connectivity, consultancy, as well as railway inspections, rolling stocks. So both of the stocks under the Ministry of Railways, increased financial independence and also increased borrowing limits is something that augurs quite well for them.
Thank you very much for that. HDFC AMC reported numbers yesterday during market hours. Looked like a good set of numbers, ticking all the boxes. Upasna joins in for details. Upasna.
Well, HDFC AMC is a stock that remains in focus today on back of its Q2 FY24 numbers. In terms of revenue, we are seeing an uptick of almost 12% on quarter-on-quarter basis. Quarterly average AUM has also seen an uptick of 8% on quarter-on-quarter basis, and revenue yields have expanded from 47.3 basis points to 49.02 basis points. Well, now talking about the quarterly average AUM contribution of equity, that has also gone up from 20 21.2% to 23.8%. Now, talking about the brokerages, Morgan Stanley has given an equal weight with a target price of 2,375. It believes that the strong equity markets are driving robust revenue for the company. However, structural yield pressures will likely to continue. HSBC has also given a hold rating with a target price of 2,580, and they say that the moderation in income yield will lead to slower earnings growth. Jefferies has given a buy ratings with a target price of 3,250. They say that the earning estimates have been raised by 3 to 4% to factor stronger equity AUM growth. CLSA has given an underperform rating with a target price of 2,770, and they say that the AUM growth of 4% sequentially, along with the improvement in the yields, will support the revenue growth, is what they have said. So all in all, we are seeing a positive commentary coming in from brokerages on HDFC AMC on the back of its Q2 FY24 numbers.
Okay, good all-round performance. Upasna, thank you very much for that. So now today, if you look at the large caps, the top Nifty gainer is HCLTech, up 2.5%, and the top Nifty loser is Infosys, down close to about 3%. Both the companies cut their FY24 guidance, yet the performance in the stock is so very divergent. So the question is why, when both of them have cut the guidance? Well, the answer is that the outlook for the next half of the year, for which is where the companies have maximum visibility, nothing beyond that. Now, the reason why Infosys cut the guidance is because their second half of the year is going to be very muted. According to the implied growth, given if you have to meet the guidance, growth is going to be negative. The company needs to do 0 to minus 2% if they have to achieve their guidance, which means the cut in guidance is because of a muted second half, a weak second half. HCLTech cut its guidance because the worst appears to be behind the company. It's the weakness in the first half of the year because of which the company cut the guidance. The outlook for the second half of the year is very promising. If the company has to meet its guidance, the revised lower guidance, they need to do about 3 to 4% in Q3 and in Q4. So that's the big difference. It's the forward-looking outlook for HCLTech, which appears to be far more promising compared to that of Infi. Infi will degrow, but HCLTech will go up 3 to 4% in Q3 and Q4. So which is why you're seeing that big difference in the stock price, despite both of them cutting their guidance. Also, a quick word, both the companies did well on margins, beating street expectations, and both the companies reported record high deal wins. We'll slip into a very short break on that note. On the other side, we turn full macro. September inflation has fallen to 5%. How does this change things on the policy front for bond markets? Lata will chat with Upasna Bharadwaj of Kotak Bank and Abhishek Upadhyay of ISEC PD.
It was a double delight for the economy. The September inflation number came in below market consensus. It's come in at 5%. Economists were expecting anything from 5.3 to 5.5%. And the second positive, of course, was the August industrial growth number coming in at 10.3. It's a little better than expectation. Expectations were running at about 9.5. I mean, I don't want to play too much on the IIP number because it's coming on a very, very poor base, but nevertheless better than expected. To analyze both numbers, I have with me Upasana Bhardwaj, Chief Economist at Kotak Mahindra Bank, and Abhishek Upadhyay, Senior Economist at ICICI Securities Primary Dealer. Abhishek, Upasana, thank you very much for joining. Abhishek, to start with you, the Reserve Bank's guess is very, very good. Their nowcast seems to be excellent. Going by the average they told us on the policy day, inflation should have come at 5 and it has come. Now, do you think all of you will have to revise your full year CPI lower towards the RBI forecast?
Well, Lata, we were at 5.30 versus RBI's 5%, but looking at the reasons for the surprise, one is volatile veggies, of course, which have declined more than what we anticipated. And second is, while core inflation is lower, it is lower partly because of a puzzling sequential drop in the housing index, which is likely to reverse next month if you go by past patterns. That said, I don't want to detract from the broadly favorable internals, particularly core inflation, where what we are seeing is even outside housing, core services, ex-housing inflation is now something like 3.6%. And this aspect of inflation contradicts what you are seeing in the West, where global central banks are struggling to really bring down services inflation. And also our own previous episodes of lower core inflation, such as in the pre-pandemic period, where we had, in FY20, we had a 4% core inflation, but most of it was because of lower goods inflation rather than services inflation. That tends to be stickier. In terms of outlook, our own assumption was RBI's forecasts were fine and we were close to it. In fact, if what we are seeing in the high frequency data on the food inflation side, in case of cereals, in case of pulses, where sequential gains were otherwise very strong in the latest data that we got. If the high frequency data is any sign, these gains are tapering out and could imply inflation in the back half of the year is closer to 5% rather than 5.5%, which RBI has penciled in. Still early days, but risks are looking like they're towards downside to RBI numbers rather than upside.
Oh, have you brought down officially your forecast? Where were you and where are you now?
So second half, we think inflation could be closer to 5% now. Earlier, we were more like 5.2, 5.3%.
Okay. Upasana, you also have had to bring down your forecasts?
Yes, Lata, I would broadly agree with what Abhishek has to say. 5.3 was our estimate, and now going by what are the internals, the second half of the year looks to be averaging around 5% versus, let's say, RBI's number of 5.4. We too were at around 5.3%. So full year average of 5.4% is where we were. Now we have officially revised it down to 5.2%.
Okay, that's good to hear. But Upasana, your note pointed out that you would still worry about pulses and cereals. Can that throw a negative surprise?
No, absolutely. I think, specifically for pulses and oilseeds and all the, sowing has not been up to the mark. And also the reservoir levels they still are below par. So going ahead, there are huge amount of risks on the food side. Food prices will remain a point of worry. We've accounted to an extent some kind of upside, but there are always shocks which tend to, surprise on either direction. And we'll have to be ready for that as well. So there are clear upside risks on the food inflation, which we'll have to be cautious about.
Okay. Abhishek, you don't think that pulses are that big a danger?
So pulses inflation is already at 13%. Of course, if you go by, past episodes of stress, in case of pulses, we have seen inflation as high as 46, 47% YOY. But I do believe government is likely to have learned from those episodes. Also, more broadly, what we are seeing is that global food prices have remained reasonably well behaved. Crude prices, despite recent geopolitical developments is still around levels that look fine. And we have not had a drought-like situation that should really catapult prices higher.
Of course.
Yes, sowing is lower, but we don't have, we likely will not have a very big shortfall in output. So in that context, I would think that upside risk of food inflation may not be as significant as we have seen in past episodes, such as after the GFC.
Fair enough. Upasana, what are the chances that the Reserve Bank is happy with this number and may not pursue with its OMO policy with that much rigor? Or do you still expect that they are going to keep the interbank call rate at 6.75 rather than 6.5, and they will continue to follow a tight policy?
Lata, whatever the respite is at the moment with the 5% inflation, I don't think anything really changes from RBI's point of view. The global situation still remains adverse. Oil prices is one risk, but besides that, we look at the US Treasury yields. Yes, because of the safe haven, because of geopolitical risks, we have seen a downward shift in the yield curve in the US, but that doesn't look to be sustainable at the moment. And if that is not the case, I don't see RBI really letting go of their guards at the moment. So the hawkishness which was sounded in the RBI policy and the needs that they have shown for a tighter liquidity will continue to be the key point of focus at this point in time. Having said that, I don't really see a very aggressive need for OMO sales. OMO sales is a tool which RBI will use as and when required to ensure that liquidity remains broadly neutral to a little tighter phase so that the overnight rates probably are closer to the MSF rates. But more so on the OMO sales side, if I was to go by the liquidity numbers, then I think the need for OMO sales could still arise more in November, wherein we are looking at liquidity being more sustainably in surplus compared to October.
Yeah, there are a goodish number of redemptions. Abhishek, your thoughts on OMO, and more importantly, what kind of a range, therefore, will you give the yields, both overnight as well as the 10-year?
Well, so we were expecting some sort of liquidity tightening measure from RBI, but were somewhat surprised with the choice of OMO sales as an instrument, because the issue with using this tool is that markets get confused whether the purpose is to withdraw liquidity or is it to really push yields higher and tighten financial conditions. We have seen in the past that because India tends to run high fiscal deficits and bond markets are anyway saddled with a huge bond supply, the scope to carry out large OMO sales is somewhat limited to begin with. That said, I do believe that to the extent OMO sales are partly meant to finish the task left incomplete by the ICRR, something like 50,000 crores of OMO sales should be anticipated. We've been surprised. We're a little surprised. Announcement has not come yet, but we do anticipate something to come soon. If liquidity tightening is the objective, then these sales will need to be front-loaded because anyways, come peak festive season and end of a year, currency leakage will bring down core liquidity surplus. But this is an aspect, the pace, the size, and the details of OMO sale operations, which is a hanging sword on the market and will continue to impact sentiment. In that context, and with global yields also heading higher, my assumption will be the downside to yields is quite limited in the near term. So we're looking at a range of, say, something like 7.25, 750, 755 for the 10-year over the next couple of months.
755. You agree, Upasana? It goes above 7.5.
We are at 750. So, it's a matter of how global situation really pans out, and hence how aggressive RBI will need to be in order to tackle the situation. So we are also in the 725 to 750 range, Lata.
I'm given to understand that Reserve Bank has been selling dollars as well today. So there could be many reasons why liquidity will tighten. Point is taken. Very quickly on growth, I didn't want to harp too much on it, but Abhishek, 10.3 is still better than the average we got. Do you think we have something good coming on growth?
Well, so as you mentioned, partly optics, but even sequentially, the performance of sectors such as capital goods, infrastructure goods continues to be very strong, and that reflects a very strong public capex. I mean, the first half of the year that we've seen. So center capex in the first 5 months is up 48%, state capex first 4 months was up 62%. So that is what is reflected in the these segments. For us, the elephant in the room continues to be exports, which are a big part of manufacturing. And on that front, what we have seen on the global growth side is that while US growth has been resilient, growth outside of US has been quite weak more recently. So export continues to be a worry, and for that reason, we think full year growth will still be lower than RBI projection of 6.5%.
You are at what, 6?
We are at 6%.
Upasana, yourself on growth?
Lata, for us, there are two factors or two segments that we are closely watching out. One, like Abhishek said, exports. We'll have to continue to monitor that very closely. But the second is also the consumption growth. While the IIP number this time for a change, consumer durables was relatively far better than what we've been seeing in the previous readings. But overall, we remain skeptical on how really the consumer demand is going to pan out, especially with rundown on financial savings that we've seen and continued labor market mixed data that we're seeing. Yeah. So I think somewhere we do remain watchful on that, where we believe that consumer demand may be fizzling off going ahead, and second half maybe seeing that pan out. So we are looking at 6.2% for the full year, with clearly the best seen already in the first quarter, and moderation will be seen in the subsequent quarters.
I know, actually, both your fears are well taken. Export, a bit of a question mark, especially with the new war raging now. And, domestic consumption, especially rural consumption. Thank you very much, Upasana and Abhishek, for joining in this conversation. I just want to put 3 numbers on the table. It's very, very early days, but I don't like the trend that this data of the 3 IT companies which announced numbers indicated. TCS has reduced its headcount by 6,333. Infosys has reduced its headcount by 7,250. And HCL has reduced its headcount by 2,250. So all told, another some 17,000 fewer jobs. And what Milind Lukkad told us at TCS is that there will be an even further or a similar reduction in headcount in the coming quarter as well. Now, if the IT companies are not going to hire, then it is going to be a consumption problem if this trend continues. I know I'm extrapolating from a small number, but that trend isn't looking good. And the software companies also bring us export earnings. So even there, we could get a hit. Those two definitely remain red flags for the India growth story. On that note, we wrap up on Bazaar. Chartbusters up.